Are we teetering on the edge of a world depression?
In this video, we'll explore alarming insights from experts like Steve Hanke and FX Evolution.
The best part? You'll get all the vital information fast.
Exactly. Find out why the yield curve might signal a looming recession and what you can do about it.
Welcome to Financial Insights in Minutes, where we deliver time-saving AI summaries so you don't have to watch hours of videos to keep up with the financial landscape.
But first, we dive into the pressing issues outlined by our expert guest, Steve Hanke.
Anchors away on our next topic. Are we heading towards a world depression?
Let's get straight to the facts. Steve Hanke suggests that troubling trends beneath recent job numbers hint at deeper economic issues.
So, what's brewing under the surface that has economists concerned? Let's dive in. So what's the central thesis here? Why are these job numbers troubling?
Hanke argues that although the headline job numbers look good, indicators like a significant drop in full-time jobs and an increase in part-time positions reveal a deteriorating economic landscape.
What's the scoop on job market trends?
The disparity is clear. While part-time roles are rising, full-time jobs are falling. It paints a concerning picture of the job market, don't you think?
Let's peel back the layers on these economic indicators.
Right. The data suggests not just losses in full-time employment, but stark declines in manufacturing jobs. What happens next could be dicey.
Interesting. How does money supply factor into this?
It's all connected. Hanke emphasizes that contraction in money supply could lead to financial strains impacting jobs, a real recipe for recession.
So what does Hanke foresee for the global economy?
If these trends continue, we might be staring down a world depression. It's critical to keep an eye on these trends for the future.
What about geopolitical factors at play?
Absolutely. Turmoil in oil-producing regions can send shockwaves through world economies. Even a small disruption in oil supply could have catastrophic effects.
So what are the concluding thoughts on this discussion?
Hanke urges caution, noting that while headlines may seem positive, deeper issues could lead to instability. It's a call for vigilance.
But hold on to your hats. Up next, we explore insights on the world's second-largest stock market crashes.
Trust me, you won't want to miss what's coming next.
Anchors away as we dive into the turbulent waters of the stock market. China's stock market just faced an epic flash crash.
Let's get straight to the facts. Last week, we saw unprecedented sell-offs. But what does this mean for investors?
Is it time to abandon ship or adjust the sails? Stay tuned as we navigate through the chaos. So, what's at stake here? The core thesis is that the Chinese market's recent crash has implications not just for local investors, but for global finance.
And let's not forget Nvidia. While it attempts to rise amidst the wreckage, the broader market looks shaky at best.
What triggered these events? Can you shed light on the dark pool activity influencing the market?
Absolutely. We saw substantial transactions at market peaks, signaling profit-taking from the recent rally, a classic sign of a market correction.
And how's the job market looking amidst all this turmoil?
The recent non-farm payrolls report surprised many, adding 254,000 jobs. It reflects strength in sectors like leisure and hospitality, despite broader uncertainties.
Looking ahead, what can investors expect in terms of market behavior?
Volatility is the name of the game. As we head into earnings season, cautious optimism may quickly turn to concern based on performance and economic indicators.
What are the predictions for this earnings season?
JP Morgan's upcoming results could be a significant market mover. Expect earnings reports to dictate trends as we close out the year.
And regarding China's economic policies,
there are growing expectations for new stimulus measures which could help stabilize the market as investors anxiously await clarity.
To wrap up, what should investors take from this chaos?
Stay informed and prepared for volatility. The signals on the horizon suggest a complex landscape in the coming months.
Final thoughts before we set sail to our next topic.
It's all about adapting to the tides. Keep an eye on earnings and adjust your strategies as necessary.
But hold your horses. Up next, we'll explore the shocking reality of Japan's economic decline.
With insights from Eurodollar University, you won't want to miss what's coming next.
Time to navigate through these waters. Why are we focusing on Japan's alarming economic downturn?
Here's the scoop. Recent data indicates Japan's leading economic indicator is at its lowest since 2020, hinting at troubling recession.
That's some serious turbulence. What's causing this storm in the economic seas? What's the core issue here?
The central thesis is that Japan is experiencing a recession due to global economic weaknesses, particularly impacted by the uncertainty surrounding the U.S. economy.
Let's break down these crucial indicators.
Right. The leading indicator plunged to 106.7, marking serious economic concern, with the government warning of a possible recession.
What about the global context behind this?
Absolutely. Japan's exports to the U.S. fell for the first time in 3 years, highlighting how interconnected our global economies truly are.
Let's navigate the policy waters.
The Bank of Japan decided to halt rate hikes, citing instability in the U.S. economy as a significant concern.
What does the future hold for Japan?
The prediction is that Japan is heading for a more traditional recession, unlike last year's unusual downturn due to supply shocks.
Any predictions on the global stage?
Indeed, we may see a synchronized global downturn as economies react to U.S. economic policy trends.
To wrap it up, what's the key takeaway?
Japan is at a pivotal point where strategic economic policies need to be enacted to navigate these choppy waters ahead.
And as we look forward, what should we anticipate?
There's much uncertainty ahead in the global landscape. Stay tuned for more updates as this situation develops.
And coming up next, don't miss our insights on 3 more months until it begins.
Trust me, there's more revealing info headed your way.
Anchors away as we dive into the mysteries of the yield curve and its recession signals.
Recent steepening of the yield curve has historical significance, hinting at potential economic shifts.
Indeed, it seems the past has some telling tales about this curve. Let's navigate through the details. So what's the main thesis? What's brewing under these economic waters?
The core message here is that the steepening yield curve often signals a recession. However, with GDP growth holding steady at 2%, it's contradictory. Why the disconnect?
Let's break down the yield curve. What's the scoop on this financial phenomenon?
The yield curve compares bond yields over different terms. Normally, long-term yields are higher. An inversion, where short-term yields exceed long-term, raises red flags.
Now let's hop aboard historical waters. What do past steepenings reveal?
Historically, every steepening marked either a recession or the onset of one, like the Great Depression and the 2008 crisis.
So here we are, a strong job market and steady growth. What gives?
Exactly. The current economic indicators seem resilient, which raises questions on the yield curve's predictive power this time.
Now, what about jobless claims? How do they play into this narrative?
Typically, they trend upward alongside yield curve steepening. However, if claims remain low, we might defer recession predictions.
Possible outcomes ahead. What could the future hold?
If initial jobless claims stay low, we might not see a recession for months, maybe even years, but we must remain cautious.
All right, let's peer into the crystal ball. What's the prediction on the recession timeline?
It's projected to possibly extend until January 2025 if the pattern holds true. Interesting, huh?
And what about the stock market during this stage?
Investors are turning bearish, predicting declines as we near a potential recession, reminiscent of past patterns.
Wrapping up this analysis, what are the key takeaways?
The yield curve's insights remain invaluable. However, current economic conditions introduce complexities that challenge traditional predictions.
And stay tuned. Coming up is an exciting shift towards insights from Bill Fleckenstein.
You won't want to miss his take on the bond market and the Fed's confidence. Trust me, it's going to be enlightening.
Anchors away as we dive into today's financial forecast. What are the latest worries in the bond market?
Bill Fleckenstein suggests that the bond market is starting to lose confidence in central bank policies.
Interesting tides ahead. Let's explore what that means for investors in the coming months. What's the crux of this discussion on the bond market?
Fleckenstein posits that we're entering a new phase after decades of stable economic policies where investors may start questioning the Fed's actions and their implications.
So, Bill, how are prevailing economic conditions shaping investor sentiment?
The economic landscape is murky. While some enjoy stability, others feel the heat from inflation and job pressures.
What about the Fed's recent actions regarding interest rates?
Fleckenstein indicates that the Fed's newfound easing during inflationary pressures is unprecedented and could lead to more unpredictability in the markets.
And what long-term forecasts can we glean from Bill's insights?
Predictions lean towards greater volatility ahead, especially if the election outcomes shift economic policies.
How are these predictions affecting market outlook?
Fleckenstein foresees a potential financial market correction as rising yields catch up with investor strategies.
Aha! What does Bill expect from the bond market moving forward?
It's a critical juncture. If the market loses faith in the Fed's monetary policy, we could see major upheaval.
To wrap things up, what final insights can we glean from Bill?
Invest wisely and remain adaptable. A savvy portfolio today may need to adjust tomorrow, especially in light of shifting economic currents.
As we consider the broader implications of this economic situation, what advice does Bill offer?
Stay informed and proactive. Many opportunities exist even amidst uncertainty, but timing and strategy are crucial to capitalize on them.
If you value these insightful analyses, hitting like and subscribing is your best way to stay updated.
Your support keeps this channel thriving and informed, so subscribe now.
As we've seen today, our guests tackled some pressing economic signals that could shape the future.
Absolutely. Steve Hanke highlighted the troubling spike in unemployment, which he views as a harbinger of economic trouble.
Meanwhile, the FX Evolution team pinpoints China's stock market crash as a potentially devastating global domino effect.
And let's not forget Eurodollar University, who raised alarms about Japan's recession poised to impact global liquidity.
Bravo's research added to the narrative with insights on the yield curve, commonly a precursor to economic contractions.
It's clear that the landscape is ripe with potential pitfalls, but understanding these signals gives us an edge.
Don't forget to like this video and subscribe for more gripping insights that can help guide your investment strategies.
Thanks for tuning in. Be sure to check out our other videos for further financial wisdom.